Welcome, curious minds. Ever wondered about the hidden gears and massive, often unseen forces that truly keep the global economy churning? Today, we're pulling back the curtain on one such powerhouse, Willis Towers Watson, or WTW. This isn't just another company, it's a strategic partner to, well, nearly every major corporation on the planet, helping them navigate the incredibly intricate worlds of people, risk, and capital. We've got a fascinating stack of sources here. Everything from their own company reports and detailed SEC filings to critical market research and nuanced industry analyses. What emerges is a vivid, almost dramatic picture of a company that has undergone a truly significant transformation, especially after a highly publicized proposed mega merger unexpectedly fell through. Our mission today is to dive deep into this mountain of information, to extract not just the facts, but the most important nuggets of knowledge and strategic insights. We want to understand not merely what WTW does, but why their actions and their evolution truly matter in the broader landscape of global business. We'll explore their recent past, the contours of their current strategic pivot, and crucially, what the future might hold. To guide us through this intricate and rather compelling story, we have our brilliant expert who can connect the dots and give us that essential, real-world context.
It's truly fascinating because what we'll uncover isn't just for investors. Understanding how firms like WTW operate actually gives you an invaluable peek behind the curtain of the global corporate world. From the employee benefits you might receive at your own company to how major corporations manage their most existential risks, their influence impacts so much more than you might initially think. It's about the very structure of how businesses function and, protect themselves.
Okay, let's unpack this behemoth then. Willis Towers Watson PLC, or WTW. As you said, a leading British-American multinational firm sits right at the intersection of advisory, broking, and solutions. At its very core, WTW provides data-driven, insight-led solutions across these three absolutely massive interconnected domains: people, risk, and capital. And when we talk about their reach, it's genuinely staggering. Their client roster isn't just impressive, it reads like a who's who of global commerce. We're talking, an estimated 95% of the FTSE 100.
Yeah, and 89% of the Fortune 1000, 91% of the Fortune Global 500.
Yeah.
Well, it's extensive. They're deeply embedded.
That kind of blue-chip client base, it must provide an incredibly stable foundation, right? A deep reservoir of recurring revenue and critical institutional knowledge.
Absolutely. That's the bedrock.
And they don't just serve these giants locally, they do it with a truly global footprint, operating in over 140 countries and markets. This isn't some regional player, it's a deeply entrenched global titan. But here's the thing. For a company with such a stable foundation now, their journey to this current structure was anything but a straight line. They've recently navigated a period of, intense upheaval, leading to a fundamental rethink of who they are.
That's absolutely the critical starting point because the recent past is truly the key to understanding the present WTW. In 2021, the entire industry was watching as WTW was on the cusp of a proposed merger with Aon, another industry giant. This deal wasn't just big, it was poised to create the single largest insurance broker in the world, a true titan among titans.
Right.
But then it fell through. The U.S. Department of Justice intervened, filing an antitrust lawsuit to block it, leading to the deal's termination. Now, you mentioned upheaval. What was the immediate fallout of such a massive, high-profile deal collapsing, especially for a company of WTW's stature?
Yeah, upheaval might actually be an understatement. The merger's termination sent shockwaves not just through WTW, but across the entire professional services landscape.
Yeah.
It created this immense period of uncertainty internally for their employees and externally for their clients in the market.
So what was WTW's strategic response? How do they navigate that immediate post-merger vacuum and begin to, reestablish their footing?
It was an incredibly fast, almost forced evolution and a true test of corporate resilience, really. The initial response was to strategically overhaul their entire operational framework. They streamlined their business into a simplified and integrated two-segment structure, which replaced a much more complex and frankly kind of siloed four-segment framework they had before.
This was a crucial move to reduce internal complexity and project a more unified image. The strategic logic here was deeply rooted in creating agility, enhancing cross-segment collaboration, basically ensuring that different parts of the company talk to each other and work together, and presenting what they call a unified value proposition to the market.
Makes sense.
Essentially, making it easier for clients to access the full breadth of WTW's capabilities, fostering what they term a one-firm approach, which is absolutely vital for improving client retention. And the numbers suggest this strategic reset is working. Post-restructuring for fiscal years 2021, 2022, and 2023, the revenue composition has been remarkably consistent. Health, Wealth and Career, or HWC, contributes a stable 60% of revenue.
60%, okay.
Debt with risk and broking, or R&B, making up the remaining 40%. This consistency isn't just a numerical detail. It's a profound insight into the success of their integration and the stability of their newly focused core. It acts as their financial bedrock, giving them predictable cash flow to fund future initiatives without, chasing every shiny object. The stability begs the question, what exactly do these two deeply integrated segments actually do? Let's dive into the core services that drive this predictable revenue.
Let's absolutely dive in, starting with Health, Wealth and Career, or HWC, which is WTW's largest business unit, as you said, 60%. Its core purpose is to address the multifaceted and ever-evolving challenges of managing human capital for their clients, which, well, we all know is increasingly complex in today's global economy. This isn't just about basic HR. It's a comprehensive suite of advice, broking, solutions, and technology that spans everything from complex employee benefit plans and institutional investments to compensation structures and benefits administration. Within HWC, they've carved out 4 primary areas of expertise. First, there's Health and Benefits, or H&B. This segment navigates the incredibly complex landscape of group benefits.
Which is a huge cost center for companies now.
Exactly. From strategic design and ongoing management to broking for medical, dental, disability, and life insurance, it's about optimizing these crucial programs, not just administering them, especially when you consider rising healthcare costs and evolving regulatory environments globally. Next up is Wealth, which further specializes into 2 critical areas. There's retirement, offering actuarial support and plan design for intricate pension plans, ensuring long-term financial stability for employees.
De-risking those legacy pensions is a big one.
Huge. Then there's Investments, providing advisory and discretionary management services for pension plans, insurers, and university endowments, essentially, helping massive pools of capital grow responsibly. Then we move to Career, which tackles the ever-important total rewards and talent issues. This involves advising on executive compensation, providing market benchmarking data so companies know how they stack up.
Always critical for retention.
Right. And even deploying sophisticated employee listening tools to gauge workforce sentiment and engagement. It's all about making sure companies attract, retain, and motivate the right talent in an intensely competitive labor market. Finally, we have Benefits Delivery and Outsourcing, or BDA. This includes their individual marketplace, connecting consumers directly with insurance carriers, and the critical administration of tax-advantaged spending accounts like health savings accounts, HSAs, and health reimbursement arrangements, HRAs. This is where the rubber meets the road for individual employees, really. What's particularly compelling about HWC, beyond the breadth of its services, is the inherent predictability and stability of its revenue. It's largely recurring, right? Derived from annual or multi-year contracts.
Yeah, that provides that high degree of revenue predictability you mentioned. It's sticky business.
Sticky business. There is some seasonality, with Q4 typically being the strongest due to the annual benefits enrollment cycles. Looking at their recent performance, in the second quarter of 2025, HWC reported $1.18 billion in revenue. That was a 6% decrease on a reported basis, but here's the crucial detail, and this is where the insight comes in. It was entirely due to the strategic divestiture of the Transaxi business.
Okay, so that explains the dip.
Exactly. That was a lower margin asset, and its sale has actually clarified and strengthened the segment. On an underlying organic basis, HWC actually demonstrated a healthy 4% growth, driven by strong global demand in both health and wealth.
So the core is still growing.
The core is growing. Plus, its operating margin expanded significantly by 190 basis points to 23.8%. Again, primarily thanks to shedding that lower margin Transaxi business. It tells you they are actively pruning to become more profitable. So that's the deeply ingrained people side of the equation, the bedrock of their services. But equally critical, and perhaps even more dynamic, is how they advise on the risk and capital side of the equation, the R&B segment.
Exactly. The risk and broking segment, or R&B, is all about providing critical risk advisory, risk transfer, and insurance placement services to a truly global client base. It encompasses a broad, sophisticated array of risk advice, insurance brokerage, and consulting services, often for incredibly complex and specialized risks that, frankly, lesser firms simply can't handle. This segment is primarily made up of 2 main businesses. First, and arguably their most visible, is Corporate Risk and Broking, or CRB. This is their core insurance placement business. Manages what, over $30 billion in premiums for clients annually?
30 billion, wow.
Yeah, it's significant. It spans numerous global specialty lines, and these are often the kinds of insurance you rarely think about but are absolutely essential for global commerce. Fascinating areas like aerospace, construction, marine, natural resources, and financial, executive, and professional risks, what they call FINEX.
FINEX, right.
Which covers everything from cyber liability to D&O insurance. They also handle more general property and casualty brokerage services, but it's those specialty lines where their expertise truly shines. The second part is insurance consulting and technology, or ICT. This business is quite specialized, providing advice and proprietary software solutions directly to the insurance industry itself.
So advising the insurers.
Exactly. They help insurance carriers, WTW's clients insurers, manage risk and capital, price their products effectively, and improve their overall business performance. It's a kind of B2B2B model, essentially. Now, the revenue characteristics for R&B are a bit more dynamic compared to HWC. Its primary sources are commissions earned on the insurance premiums they place for clients, along with fees for brokerage and consulting. What's crucial to understand here is that commission-based revenue is inherently cyclical. We know that hard markets, characterized by rising premium rates, provide a tailwind to their commission revenues.
Times for brokers.
Right. Conversely, a soft market with declining premium rates puts significant pressure on those revenues. So knowing where we are in that cycle is always a critical factor for R&B. In terms of recent performance, R&B has truly been a key engine of growth for the transformed WTW. In the second quarter of 2025, it reported a strong 7% increase in revenue, which was 6% on an organic basis, totaling $1.05 billion.
Nice growth there.
Yeah, robust performance. Driven by consistently high levels of new business activity and strong client retention rates within that CRB division. Their operating margin also improved by a healthy 60 basis points to 21.2%, a result of what we call positive operating leverage, meaning their revenues are growing faster than their operating costs, combined with cost savings from the company's multi-year transformation program. It's a powerful combination when it works. While WTW's business is geographically diverse, serving those 140 countries, there's a significant concentration in developed economies. For example, in fiscal year 2023, the United States accounted for 53% of total revenue,
Over half.
with the United Kingdom contributing 18%. But what's equally reassuring and crucial for stability is their vast client diversification across numerous industries, with no single client making up a significant concentration of revenue. This offers incredible resilience against downturns affecting any one particular sector. Zooming out for a moment, we see how these two distinct but deeply integrated segments form a coherent, global offering, each with its own characteristics and growth drivers. But the critical query becomes, how does this reinvented WTW stack up against its formidable rivals in a market that is constantly evolving and, frankly, quite unforgiving?
That's the perfect question because WTW operates within this massive and incredibly dynamic professional services and insurance brokerage industry. We're talking about a global market estimated to be between, $287 billion and $313 billion in 2023-2024 alone?
Huge market.
Huge. And here's where it truly becomes compelling for any participant. The outlook is incredibly favorable, with consensus forecasts projecting a robust compound annual growth rate, or CAGR, of between 8.2% and 9.5% through 2030-2034.
Wow, that's strong growth.
Right. That means the total market could surge to over $500 billion to $750 billion by the end of that period. That's a powerful, undeniable secular tailwind for all major players who can capture it. So what's driving this kind of phenomenal growth? Well, the world is becoming an increasingly complex and interconnected place, and that directly translates into more risk.
Definitely seeing that.
We're seeing more sophisticated cybersecurity threats, the undeniable realities of climate change risks, and heightened geopolitical instability, all fueling an insatiable demand for sophisticated risk advisory and transfer solutions. On top of that, there's a rising demand for personalized insurance products, both for individuals and corporations, and the ongoing, sweeping digitalization of the entire industry, which creates entirely new avenues for growth and client engagement. Geographically, North America is currently the largest and most mature market, but Asia-Pacific is anticipated to be the fastest-growing region in the coming years. Now, with that kind of growth, the competitive arena becomes even more intense. So the plot thickens when we look at who the major players are in this expanding market and where WTW currently fits in.
The competitive arena for global insurance brokerage is quite distinct at the very highest level. It's largely an oligopoly, often referred to as the Big Four. The undisputed industry leader remains Marsh & McLennan Companies, or MMC, which reported a staggering $22.7 billion in total revenues in 2023.
MMC, always number one.
Pretty much. Aon Plec, the company WTW almost merged with, firmly holds the number 2 position with $13.4 billion in 2023 revenues. Now, for many years, WTW was consistently established as the third largest global broker. However, based on the 2023 revenue figures, Arthur J. Gallagher & Co., or AJG, actually surpassed WTW.
AJG overtook them.
They did. AJG reported revenues of $9.91 billion compared to WTW's $9.48 billion. This means WTW is now positioned as the #4 global broker.
Number 4, that's a big shift.
It is. And in the strategically critical U.S. market, they also hold the #4 position, reporting $5.1 billion in U.S. brokerage revenue in 2024. What's truly fascinating here, and a key insight into the underlying competitive dynamics, is that the market for serving large, complex multinational corporations is particularly concentrated. The U.S. Department of Justice, in its 2021 antitrust lawsuit to block the Aon-WTW merger, explicitly defined this submarket as being dominated by Aon, Marsh, and WTW.
So the DOJ saw them as a distinct top tier for the biggest clients.
Exactly. The DOJ argued these 3 firms possess unique competitive advantages in terms of their broad datasets, deep institutional experience, and unmatched global scale that smaller brokerage firms simply can't replicate. This means that even with AJG's ascent, there's still intense, direct head-to-head competition among this core group for the world's most demanding clients. This shift in rankings wasn't just a random statistical anomaly. It's a direct and significant consequence of some very impactful strategic decisions and the surrounding circumstances. It tells a much deeper story.
It absolutely does, and the Aon merger fallout is central to unraveling that story. You see, while WTW's management and extensive resources were consumed by the lengthy and ultimately unsuccessful merger process with Aon, a deal that spanned years of negotiation and regulatory scrutiny.
A huge distraction.
Huge. AJG, their now ascendant rival, was executing something entirely different, a relentless, aggressive growth-by-acquisition strategy. This created a stark divergence in their paths, almost a tale of 2 companies at a critical juncture. And here's the profound irony, a twist of fate that actually benefited AJG. To gain regulatory approval for their proposed merger, WTW had agreed to divest a significant portfolio of assets, most notably its entire reinsurance brokerage arm, Willis Re.
Right, Willis Re, a big piece of the business.
Huge piece. And AJG was positioned as the intended buyer. Even though the main merger between Aon and WTW collapsed in July 2021, the sale of Willis Re to AJG still proceeded as a separate transaction for a substantial $3.25 billion in December 2021.
So AJG got Willis Re even without the main deal happening.
Exactly. It's kind of incredible when you think about it. This divestiture was monumental. It literally removed a substantial and historically important revenue stream, a cornerstone of WTW's risk business, and directly transferred it to a key competitor, AJG. This asset transfer, more than anything else, was a primary contributor to that shift in market share rankings we observed in the 2023 results, creating a more challenging and intensely competitive dynamic for WTW as it now seeks to regain its former position. It truly reshaped the landscape for them. So this wasn't just a failed merger. It was a profound, almost involuntary reshaping of the competitive landscape for WTW. But beyond these top-tier rivalries and the drama of mega deals, what other powerful industry forces are at play? What else is stirring the pot?
Well, stepping back for a moment, we see that while the very top of the market might be consolidated, the broader industry remains incredibly fragmented. This fragmentation continues to fuel a high level of merger and acquisition, or M&A, activity. Both large strategic players, like AJG obviously, and an increasing number of private equity-backed firms are aggressively consolidating the market by acquiring smaller regional brokers.
PE firms are big in this space too, then.
Oh, increasingly so. What's interesting, however, is that data suggests that smaller, more agile brokers have collectively been gaining market share from the largest incumbents, with their share growing from about 2.5% in 2020 to 3.4% in 2022.
So scale isn't everything.
It demonstrates a dynamic market where pure scale isn't the only or even necessarily the most powerful advantage anymore. Agility counts. Technology, for example, stands as a paramount disruptive force. Digitalization, the pervasive application of artificial intelligence, or AI, and advanced data analytics are fundamentally transforming how services are delivered. They're creating new efficiencies and significantly enhancing the overall client experience. Firms across the industry are now making substantial investments in AI-powered solutions to automate compliance monitoring, provide predictive client needs analysis, basically anticipating what clients will need before they even ask, and streamline internal processes.
So AI is becoming table stakes.
It really is. This recognizes that technological leadership is no longer a luxury. It's now a critical component of maintaining any competitive edge. The regulatory environment is another significant factor, acting as both a considerable challenge and, paradoxically, an opportunity. The industry is highly regulated globally, with an increasing focus on critical issues such as data privacy, like GDPR in Europe, and robust cybersecurity protocols.
Right, compliance must be a headache.
It creates significant compliance burdens, which can be costly. However, this very complexity also drives demand for the specialized advisory services that firms like WTW provide, as companies desperately need expert guidance to ensure they are compliant, protected, and, well, future-proof. So given these intense challenges, the reshuffled competitive landscape, the ongoing consolidation, and the relentless march of technology, the critical query becomes, how exactly is WTW differentiating itself today? And what are its core, durable advantages, its moats, in this new environment?
You've hit on the absolute heart of the matter. In a market this competitive, with rivals breathing down your neck, you need genuinely durable advantages, what we often call moats, something that protects your business from the competition. WTW, even after its recent turbulence, definitely has a few, and they're evolving them. Their most significant differentiator, in my view, is their integrated people, risk, and capital model.
That holistic approach.
Exactly. The ability to offer clients this holistic suite of solutions, spanning from human capital management and HWC to sophisticated corporate risk management and insurance placement in R&B, provides a comprehensive, interconnected value proposition that is incredibly difficult for more specialized or siloed competitors to truly replicate. It means they can build much deeper, more strategic client relationships, acting as a single, indispensable partner across multiple critical business functions. Another core competitive advantage, deeply tied to their historical strength, is their vast data and analytical capabilities. WTW leverages massive proprietary data sets and sophisticated analytical tools to deliver truly insight-led solutions.
Going back to that DOJ point again.
Precisely. Think back to what the U.S. Department of Justice argued in the Aon merger challenge. They explicitly highlighted that the big three brokers possess a distinct advantage in their ability to harness broad data and deep institutional knowledge that smaller firms simply cannot easily match. This isn't just about having data, it's about the capacity to analyze it, derive actionable intelligence, and provide more nuanced advice and customized solutions, especially for those incredibly large, complex risks that require a unique level of foresight. And finally, their global scale, combined with that premier client base, is a colossal advantage. With a physical presence in 140 countries, WTW has the undeniable global footprint necessary to serve the needs of the world's largest multinational corporations, no matter where their operations extend.
That reach is hard to replicate.
Very. And these are transactional relationships. These are deep, long-standing relationships with blue-chip clients, characterized by high retention rates, which provides a substantial base of recurring revenue. That creates an incredibly stable and predictable business model, something any CEO would covet. So those are their formidable foundational strengths, their moats. But they aren't content to simply rest on those. They're actively pursuing a number of strategic initiatives to sharpen their edge even further. What are they actually doing on the ground to make this happen?
It's a multi-pronged approach, and it reflects their renewed focus. First, there's a strong emphasis on specialization, particularly in their core broking business. They are actively targeting niche markets and incredibly complex risk classes where deep technical expertise is the primary differentiator. Management has explicitly stated that a key element of their strategy is to win business not on price alone, but on this deep technical knowledge, which also, critically, allows them to command higher margins. Where are they specifically finding these niche markets, and how difficult is it to staff those with the right expertise, especially after the talent disruption of the Aon merger?
That's a fantastic question, because finding and staffing these niches is a strategic challenge in itself. They're looking at areas like advanced cyber insurance, complex D&O liabilities for global firms, and specialized segments within aerospace or energy where the risk profiles are so unique that, frankly, only a handful of firms truly understand them.
Highly specialized indeed.
And attracting and retaining the top talent for these areas is incredibly difficult because it requires a rare blend of technical insurance knowledge, deep industry understanding, and exceptional client relationship skills. It's a constant, high-stakes recruitment battle out there.
Precisely. And that ties into their second major initiative. Significant investment in technology platforms to modernize service delivery and drastically improve operational efficiency. For instance, they've introduced Neuron, a digital trading platform specifically designed to streamline the placement of complex risks like directors and officers, or D&O and cyber insurance.
We're on it.
They also have a new global broking platform that's intended to seamlessly connect brokers with insurance markets worldwide, making the process faster and more transparent. This is about leveraging technology to be more responsive and intelligent for clients. Closely related is the ambitious application of AI and automation. Management has highlighted early, but incredibly promising, results from using AI-powered solutions to enhance real-time analytics and automate routine data processing tasks. They've even reported efficiency gains of as much as a 75% reduction in processing time in some instances. A 75% reduction. Can you give us a concrete example of a task where AI is delivering that, and what are the biggest hurdles to scaling that across the firm?
Absolutely. A 75% reduction is huge. Think about the mountain of paperwork and data entry involved in processing new insurance policies or complex benefit claims. It's immense. AI is being deployed to instantly extract and verify information from documents, cross-reference it against existing databases, and even pre-populated forms, essentially cutting out hours of manual labor per task. It's a game changer for workflow.
Right, automating the grunt work.
Exactly. The biggest hurdles to scaling it are probably twofold. First, integrating these new AI systems seamlessly with legacy IT infrastructure, which is, common in large established firms. It's never easy.
Always a challenge.
And second, ensuring data quality and governance, because AI is only as good as the data it's fed, and dealing with sensitive client data requires impeccable security and regulatory compliance. It's a massive undertaking, but the potential upside is clearly immense.
Indeed, the strategic goal here is twofold. Improve operating margins by becoming leaner, while also freeing up highly skilled colleagues to focus on higher-value, client-facing advisory work rather than mundane tasks. This allows their human capital to deliver more strategic value.
More brain, less paper pushing.
Pretty much. Finally, talent remains a critical differentiator. As a professional services firm, their people are their primary asset. While the uncertainty around the Aon merger led to some employee departures, which was inevitable,
Understandable.
WTW is now strategically rebuilding its talent base with renewed vigor. A clear signal of this commitment, and a testament to their ability to attract top talent, is the high-profile recruitment of Lucy Clark from her role as president of Marsh Specialty to become WTW's president of Risk and Broking in 2024.
There was a big hire. A real statement.
It was a huge signal, demonstrating their focus on attracting world-class leadership and expertise back into the fold. This brings us to a crucial point about their overall strategic evolution, a philosophy that is fundamentally different from their past. It's a subtle but powerful shift in thinking.
You're absolutely right. There's been a truly profound philosophical shift at WTW. Let's contrast their previous strategy, particularly the aggressive pursuit of the Aon merger, which was, in essence, all about creating the world's largest insurance broker, a kind of scale for scale's sake approach.
Size above all else.
Right. The current philosophy, forged in the painful aftermath of that deal's collapse, is far more nuanced, more refined. It's what they now call smarter, more efficient scale. They acknowledge, quite realistically, the difficulty of competing with the now significantly larger Marsh & McLennan and Aon on pure size alone. So instead of sheer volume, WTW is focusing on becoming more agile and technologically advanced.
Playing a different game.
Exactly. This means leveraging their vast data assets more intelligently, investing heavily in efficiency-driving platforms like Neuron, and building deep expertise in those specialized high-margin niches we just discussed. This represents a strategic shift from a volume-based approach to a value-based one, aiming for a more defensible and potentially higher-margin business model. It's a really interesting pivot, moving from an attempt to brute force to a more surgical, intelligent approach. So with all these strategic shifts, what does this actually mean for their bottom line? Let's dive into their financial performance and where the numbers indicate they're heading.
Well, an examination of WTW's financial performance over the past 5 years truly reveals remarkable resilience, especially considering the strategic upheaval they've navigated. From 2019 to 2024, total revenue grew steadily from about $8.37 billion to $9.93 billion.
Solid top-line growth.
Yeah, but what's truly fascinating here, and often the most insightful metric, is their organic revenue growth. This key metric, which strips out currency fluctuations and M&A, consistently demonstrated robust mid-single-digit figures, hitting 6% in 2021, 8% in 2023, and 5% in 2024.
So the underlying business kept growing even during the merger chaos and restructuring.
Exactly. This ability to maintain such solid underlying growth through a period of immense internal and external disruption really speaks to the durability of their client relationships and the truly essential nature of their services. It shows the core business was robust even when the company itself was undergoing a radical transformation. While those revenues have been solid, the real story of their transformation often lies in the profitability metrics, which tell a more nuanced tale of their journey.
That's absolutely where the rubber meets the road. Because if you just look at JAP-reported operating margins, they've been incredibly volatile, all over the place. For instance, there was a spike to 24.5% in 2021, but that was heavily skewed by the $1 billion termination fee they received from Aon.
Right, the breakup fee.
Exactly. Then you see a sharp drop to 6.3% in 2024 due to significant one-time costs tied to their multi-year transformation and restructuring programs. So looking solely at GAAP can be incredibly misleading.
You need to look past the noise.
You really do. That's why the adjusted operating margin provides a much clearer, cleaner picture of the company's core underlying profitability as it strips out those one-time items and extraordinary costs. And what we see there is a consistent and truly impressive upward trend. Their adjusted operating margin expanded from 18.6% in 2019 all the way up to a robust 23.9% in 2024.
Consistent expansion, that's impressive during restructuring.
It really is. This steady improvement demonstrates powerful execution on cost management initiatives and highlights the underlying pricing power of the business, even in a competitive market. The fact that these margins expanded even while the company was incurring substantial cash costs for its transformation program is a strong indicator of management's operational discipline and their commitment to efficiency. What's more, as those cash outlays for the transformation program, which officially concluded in 2024, begin to roll off, the company should experience a significant tailwind to its free cash flow conversion.
So the costs fade, but the benefits remain.
Exactly. The margin benefits of a more efficient structure will remain, but the associated costs will disappear, creating a powerful leverage point going forward. Margins are excellent for profitability, but ultimately for any company and for any investor, it's about the cold, hard cash, isn't it?
Precisely. Cash is indeed king, and WTW has proven to be a strong and consistent generator of free cash flow, a critical measure of a company's financial health and flexibility. They produced a robust $1.2 billion in 2023 and an even stronger $1.4 billion in 2024. Strong numbers.
Way strong.
Now, there was a temporary dip in free cash flow for the first half of 2025, declining to $217 million from $305 million in the prior year period.
Okay, why the dip?
Management has been quick to attribute this to timing differences related to compensation payments and cash taxes, as well as the absence of cash flows from the divested TransactSeed business. The company's reaffirmation of its full-year financial framework suggests that this first-half performance is truly not indicative of a change in the underlying, powerful cash-generating power of the business. It's important for listeners to differentiate between temporary timing issues and fundamental operational shifts. Now that we've seen the historical performance and the story the numbers tell, let's pivot to what's driving their future growth, looking ahead.
Right, the outlook. Management is remarkably confident about the full year 2025, guiding for sustainable mid-single-digit organic revenue growth overall across the company. Digging deeper into the segments, HWC is expected to continue growing in the mid-single-digit range, led by a strong high single-digit growth in the health business line.
Health continues to be a major driver then.
It seems so. This is really driven by persistent, almost insatiable demand from clients for solutions that help them manage rising healthcare costs and, crucially, de-risk legacy pension obligations, an enormous and ongoing challenge for many corporations. This provides a very stable, almost recession-resistant foundation for growth. R&B, on the other hand, is projected to be the faster-growing of the two segments, with an expected growth rate in the mid to high single-digit range.
Faster growth in risk and broking makes sense given the market dynamics.
Yeah. Within R&B, the corporate risk and broking, or CRB, business has been a standout performer, delivering an impressive 10 consecutive quarters of high single-digit organic growth, excluding book of business sales, as of the second quarter of 2025.
10 quarters straight, that's consistency.
That kind of consistent performance is a testament to their specialized expertise and strong client relationships. And crucially, for that Smarter, more efficient scale strategy? Margin expansion remains a central pillar of the company's investment thesis. Management has set a clear target for approximately 100 basis points of average annual margin expansion specifically within the R&B segment over the next 3 years.
A full percentage point per year in R&B. Ambitious.
Very. With additional incremental gains expected across the entire enterprise. This ambitious goal is predicated on achieving greater operating leverage from strong revenue growth, realizing further efficiencies from the completed transformation program, and benefiting significantly from those strategic investments in technology and automation we discussed earlier. In fact, their investments in platforms like Neuron and the broader application of AI are expected to be key enablers, not just for internal efficiencies and margin expansion, but also for dramatically enhancing the quality and sophistication of client solutions, which in turn can lead to new revenue opportunities. It's a virtuous cycle they're aiming for. With all this cash generation and these clear growth plans, how are they deciding to use their capital? This is another critical area where their strategy has significantly changed, signaling a new philosophical approach.
Absolutely. WTW's portfolio management in recent years has been fundamentally defined by a series of strategic divestitures, each aimed at simplifying the business, sharpening its focus on core strengths, and critically generating capital for new strategic priorities. The most significant divestiture, of course, was the sale of the company's treaty reinsurance brokerage arm, Willis Re, to Arthur J. Gallagher & Co. for that substantial $3.25 billion in December 2021.
The deal that helped AGG overtake
The
them.
very one. This was a landmark transaction that not only reshaped the reinsurance brokerage landscape, but, perhaps more importantly for WTW, provided them with a massive capital infusion to fund its new post-merger capital allocation plan. More recently, in a move to further streamline its HWC segment, WTW sold Transashi, that direct-to-consumer healthcare marketplace, to the private equity firm GTCR at the beginning of 2025 for $632.4 million.
Right, the business that impacted the HWC reported revenue recently.
Exactly. While it's worth noting, WTW had originally acquired Transaxi for $1.3 billion, which, suggests it might not have performed to initial expectations.
Took a loss there, potentially.
Potentially on paper. But this sale, though creating a short-term EPS headwind in 2025, simplifies the HWC portfolio. It allows management to relentlessly focus on its higher-margin, core B2B advisory and solutions businesses, aligning perfectly with that smarter, more efficient scale philosophy. These divestitures freed up an enormous amount of capital. How they chose to deploy it after the Aon disappointment and how they continue to signals a very clear and distinct prioritization.
You bet it does. Returning capital to shareholders has clearly become the primary and most prominent use of the company's robust free cash flow and those substantial divestiture proceeds. They've really embraced an aggressive share repurchase program. For example, right after the Aon deal termination in September 2021, management immediately announced a plan to return over $4 billion to shareholders through buybacks by the end of fiscal year 2022. That's a powerful signal of confidence in their own valuation.
Huge commitment right after the deal failed.
Huge. This program has continued robustly, with $901 million of shares repurchased in 2024 and another $500 million in the second quarter of 2025 alone. Their guidance for FY 2025 is approximately $1.5 billion in total buybacks.
So they're still buying back aggressively.
Very aggressively. This sustained large-scale activity has significantly reduced the company's share count. And for investors, that directly translates into a strong underpinning for earnings per share, or EPS growth. Basic math. Alongside these aggressive buybacks, WTW maintains a policy of paying a steady, growing quarterly dividend, recently set as 92 cents per common share. They boast a track record of 8 consecutive years of dividend growth, which is commendable.
8 years is solid.
It is. However, it's worth noting that their 3- and 5-year dividend growth rates, at about 3.6% and 6.5% respectively, tend to lag those of some key peers like Arthur J. Gallagher.
Some buybacks are clearly the priority over dividends.
Clearly. This indicates that while dividends are present, share repurchases are their preferred and more significant method of returning capital to shareholders, reflecting management's belief that their own stock is an attractive investment. So beyond just returning capital, they're also making strategic investments, but with a philosophy that feels distinctly different from the past, like you said.
Exactly. At its 2024 Investor Day, management outlined what they call a rebalanced capital allocation approach. This strategy aims to both elevate its core businesses and generate attractive shareholder returns, striking a careful balance between returning capital and making disciplined organic and inorganic investment to support long-term growth. A prime example of this new, more nuanced approach is the company's announced re-entry into the treaty reinsurance broking market.
Wait, re-entering reinsurance after selling Willis Re?
Yes, but in a very different way. Rather than undertaking a costly and time-consuming effort to rebuild the business it sold off to AJG, WTW has instead formed a clever joint venture with Bain Capital, a leading private investment firm. Under this arrangement, WTW will hold a minority stake in the new entity. This capital-light structure is quite brilliant from a strategic perspective.
Ah, capital light, so not a huge investment.
Precisely. It allows WTW to participate in the strategic and financial upside of the reinsurance market, a segment they know intimately without a large upfront capital outlay. This preserves their precious financial flexibility and, crucially, their capacity for continued share repurchases. It's a very different way of achieving strategic goals, leveraging partnerships rather than massive self-funded endeavors. This evolution in capital allocation is a powerful signal. It tells a story about how they've learned from the past, perhaps.
It truly is a fundamental change in philosophy, a powerful signal indeed. You can dramatically contrast that all-in bet on the Aon mega merger with the current strategy, which is dominated by these aggressive buybacks and creative, capital-efficient partnerships like the Bain Capital JV.
Night and day, really.
Totally. This new approach is arguably more shareholder-friendly and demonstrably less risky, especially given the antitrust hurdles they faced before. It elegantly balances near-term returns through those significant buybacks with long-term strategic positioning without overextending the balance sheet. This strategy also sends a very strong signal of management's confidence, effectively telling the market that they believe WTW's own stock is one of the most attractive investments available, period. So what does this all mean? They've made these big strategic moves, they've restructured, they're investing differently. But every company, no matter how powerful, faces headwinds and challenges. Let's look at the risks and what we should watch out for.
It's absolutely crucial to consider the potential headwinds that WTW, like any global giant, will inevitably face. First, demand for their more discretionary consulting projects, particularly within the HWC segment, can be quite sensitive to economic downturns.
Right, consulting is often first to get cut in a downturn.
Exactly. If businesses pull back on spending, these projects could see reduced client engagement. Second, the R&B segment's commission revenues are significantly influenced by insurance market cyclicality. A soft insurance market characterized by falling premium rates could exert significant downward pressure on their revenues and subsequently their margins. Third, competitive intensity remains incredibly high. WTW operates in an intensely competitive industry, facing not only larger players like Marsh & McLennan and Aon, but also incredibly aggressive acquirers like Arthur J. Gallagher.
Can't rest on your laurels.
No way. This fierce competition can lead to pressure on market share and pricing, forcing WTW to work harder to maintain its position. And finally, as a truly global company, WTW is inherently exposed to geopolitical and broader global risks. This includes political instability, international conflicts, sudden changes in trade policies, and currency fluctuations, all of which can disrupt markets, impact client operations, and create significant economic uncertainty. Beyond these external, often uncontrollable factors, there are also risks specific to WTW's internal operations and its carefully laid out strategy.
You're right. No company is entirely immune to its own specific vulnerabilities. For WTW, there's significant execution risk. Their future performance heavily depends on the successful, flawless execution of their strategic plan. Those initiatives for technology, specialization, and talent we talked about. There's always a risk that these complex initiatives might not deliver the projected growth, profitability, or cost savings due to flawed assumptions or, inadequate implementation. It's a massive undertaking. Then there's key personnel dependencies. As a professional services firm, their success hinges entirely on their ability to attract, retain, and motivate top talent. The market for this kind of specialized expertise is intensely competitive.
The war for talent is real.
It is. And the loss of key individuals or high-performing teams could really harm critical client relationships and project delivery. That Lucy Clark hire was a powerful statement for a reason. It highlighted the importance of leadership. Cybersecurity breaches are another major, ever-present concern. WTW stores and processes vast amounts of sensitive client and personal data across the globe, making it a prime target for sophisticated cyber attacks.
Huge target.
A significant breach could result in material financial losses, crippling regulatory fines under regimes like GDPR, extensive legal liability, and perhaps most damagingly, severe reputational damage in an industry built on trust. Along with that is the risk of technology obsolescence. If they fail to continually invest in and effectively implement new technologies like AI and advanced data analytics, it could quickly erode their competitive advantage, turning their modern systems into legacy ones before you know it. Lastly, they face considerable legal and regulatory risks. They're exposed to errors and omissions, or E&O, claims from clients, which can be costly. They must navigate incredibly complex global compliance requirements across over 140 countries, from intricate insurance regulations to data privacy laws and anti-corruption statutes.
A minefield.
Truly. And managing potential conflicts of interest that can arise from their diverse operations is a constant challenge. Failure to navigate any of these could lead to significant fines, costly litigation, and again, immense reputational harm. Given all these dynamic factors, analysts often frame a company's future in terms of different scenarios: the best case, the worst case, and the most likely. Let's explore those for WTW.
Absolutely. When we look at WTW's potential future, we can outline three main scenarios to help frame expectations. The base case assumes steady, consistent execution of their current strategy. Here, we'd expect organic revenue growth to continue in the mid-single-digit range, around 4–6%, consistent with management's guidance. They'd also successfully execute their margin expansion plan, delivering a steady 50–75 basis points of annual adjusted operating margin improvement, and continue their disciplined capital allocation, including that $1.5 billion annual share repurchase program. The macroeconomic environment would remain relatively stable.
So, kind of steady as she goes.
Pretty much. The outcome: consistent high single-digit to low double-digit adjusted EPS growth, with a gradual, modest re-rating of the stock's valuation, though it might still trade at a slight discount to larger peers due to its #4 ranking. What specific data point would you watch most closely to confirm we're on this base case trajectory?
For the base case, I'd hone in on their organic revenue growth within the R&B segment. If that consistently hits the mid to high single-digit guidance they've set, say 5–7%, it suggests they're effectively competing for new business and retaining existing clients despite the competitive landscape. It validates the effectiveness of their specialization strategy in their growth engine.
Good call. Then there's the bull case, which envisions accelerated growth and margin expansion. Catalysts here would be margin expansion outperformance, where they achieve over 100 basis points of annual improvement.
Beating their own targets.
Right. Perhaps driven by faster-than-expected efficiency gains from new technology platforms like Neuron and truly successful AI application across the firm, organic revenue growth would accelerate into the high single-digit range, maybe 7–9%, perhaps fueled by significant market share gains, exceptional cross-selling between HWC and R&B, and a sustained hard insurance market that boosts commissions. Plus, the new reinsurance joint venture with Bain Capital would prove highly successful, quickly contributing meaningfully to earnings. The outcome: sustained mid-teens or higher adjusted EPS growth, driving substantial shareholder value through both earnings growth and a significant multiple re-rating, effectively closing the valuation gap with their larger peers.
That sounds like an ideal scenario, the stars aligning. But on the flip side, we have the bear case, where competitive pressures and macro headwinds really stall momentum. What are the key warning signs here? What should make us nervous?
The warning signs are crucial. Risks include intensified competition leading to market share losses and maybe low single-digit organic growth, like 1–3%, indicating a failure to gain traction. They might fail to hit their margin targets, maybe only getting 0–25 BPs or even seeing contraction due to persistent wage inflation, higher than expected reinvestment needs, or simply a lack of operating leverage.
The margin expansion stalls out.
Exactly. A severe economic downturn could cause a significant pullback in corporate spending across the board, leading to declining revenue and profitability, exacerbated by a softening property and casualty insurance market hitting R&B hard. And of course, execution missteps like problematic tech rollouts or a failed reinsurance JV could weigh heavily. The outcome here is WTW would struggle to grow earnings, potentially seeing EPS decline, and the stock's valuation multiple would likely contract further. What stands out to you among these scenarios, and what single metric would you monitor to quickly identify if WTW is veering towards either the bull or bear case?
For me, the one metric that would quickly signal a veer toward the bull or bear case is adjusted operating margin expansion, specifically that year-over-year basis point change. If we see them consistently exceeding that 100 basis points target in R&B and showing solid gains overall, say 75 plus BPs company-wide year after year, it suggests their smarter, more efficient scale is truly delivering, leaning towards the bull case. Conversely, if that expansion stalls out, maybe hovering around 0.25 BPs annually or worse, reverses, it indicates significant headwinds or execution issues, regardless of revenue. It's the ultimate barometer of their strategic success or failure, I think. Leaning towards the bear case, then, that's a lot to consider, and it gives us a really detailed picture of WTW's journey. So for our listeners who are tracking WTW, maybe interested investors or just industry watchers, what are the absolute must-watch numbers, the KPIs they should have on their dashboard?
Great question. The absolute most critical top-line metric is organic revenue growth, particularly when broken down by segment. You need to track both HWC and R&B against their targets, as it strips out the effects of currency and M&A, giving you the clearest view of underlying business momentum. Is the core growing? Next, keep a very close eye on the adjusted operating margin. As you said, this is the best indicator of their core profitability and the success of those critical efficiency initiatives. Watch for the year-over-year basis point change to validate that margin expansion thesis. While not always publicly precise, listening carefully for management commentary on client retention rates is crucial for understanding client satisfaction and the inherent stickiness of their revenue base. Are they keeping the clients they have?
Qualitative but important.
Very. Similarly, details on their new business pipeline and win rates provide an essential forward-looking indicator for future revenue generation. Are they winning new deals? For profitability and capital efficiency, return on invested capital, or ROIC, which was reported at 9.17% as of August 2025, measures how efficiently they're allocating capital. Is that 9.17% a strong return for a professional services firm of this type, especially after such a massive strategic pivot? It's a good question to ask and compare to peers.
Needs context, definitely.
Right. And of course, adjusted diluted EPS is the primary driver of shareholder returns, so diligently track its growth rate. On the cash flow front, free cash flow, FCF, and FCF conversion are key measures of earnings quality and the funds available for shareholder returns and strategic deployment. Is the cash actually hitting the bank? Finally, from a balance sheet perspective, monitor the debt-to-EBITDA ratio to ensure their aggressive buybacks aren't being funded by an unsustainable increase in debt. And don't forget segment-specific KPIs like the P&C insurance market cycle for R&B and corporate spending on benefits and retirement for HWC. These external factors heavily influence each segment.
That's an incredibly comprehensive list, and it really gives us a detailed, actionable picture of WTW. Lots to track. Hashtag tag outro. Today, we journeyed through the intricate and frankly dramatic world of Willis Towers Watson. We explored its global reach, its very public strategic pivot following a failed mega merger, its powerful core business segments, the reshaped competitive landscape it navigates, and the detailed financial mechanics driving its future. It's a compelling story of resilience, isn't it?
Zooming out to the bigger picture, WTW's story isn't just about one company's journey. It's a powerful illustration of how even the largest, most established firms must constantly adapt and evolve their strategy. From pursuing pure, unadulterated scale, they've shifted to a more focused, technologically driven, and, well, arguably more shareholder-friendly approach. It shows that in a dynamic, global market, strategic agility and intelligent resource allocation are just as critical, maybe even more critical, than sheer size.
So, what does this all mean for you listening? Consider how this pivot from scale at any cost to smarter, more efficient scale might influence other major players in competitive industries. Could WTW's strategic evolution set a new blueprint for how established giants navigate relentless disruption and fierce competition in a world that never stands still? That makes you wonder, doesn't it? That wraps up our deep dive for today. We hope this gave you a shortcut to being incredibly well informed about WTW and the broader, fascinating professional services landscape. Until next time, keep digging for those insights.